Great to see you again. What a morning between equities and what's happened in yields. I wonder how you're thinking about the price action today, and then how much is due to the data itself or some of the evolving Fed speak that we've gotten over the last, say, 48 hours.
What a morning. I mean, we are seeing the best day for the NASDAQ composite since April 2020, which is just wild when you think about what was happening back then. The economy was shutting down. We were at the onset of the pandemic. And here we are 2 years later, and we're seeing that type of volatility again. It's really the return of the long duration trade that we're seeing, right? The FANG stocks jumping, the NASDAQ outperforming, ARK is up 10%. Obviously, this move in Amazon with yields lower. I would like to zoom out a little bit, though, and just point out that we have seen some pretty big rallies throughout the year in tech, in these long duration trades, and they've proved to be short-lived, right? They've quickly fizzled, as we saw over the summer. Every time investors have piled into tech, piled into growth, hoping for some sort of Fed pivot, their hopes have been quashed, and those trades have ended up fizzling. So this is a key trade to watch. Is it different this time?
Yeah, the Journal did a pretty nice job last month of actually predicting how health and insurance inflation and maybe even medical care, the shifts in methodology would end up helping to keep overall inflation capped. That's exactly what happened. Are there, as we sometimes say in earnings, is there hair on this print, do you think, or not?
Well, I think I keep thinking of Fed Chair Powell's remarks, right, months ago when he said that this is not a time for nuanced readings of inflation. They want to see a sustained decrease. And so far, this is one print. And I think a lot of what's driving today is that people, have gotten so bearish on tech. And then at the same time, you have people who continue to buy the dip in tech and still hold on to that trade. I had one investor say to me recently, there are investors who haven't really seen the type of high yield environment that we're in right now in their careers, the past 10 or 15 years. They don't know a playbook for this environment. So that's what makes, reading inflation, figuring out how to position in tech so challenging right now.
Yeah, so Gunjan, some of the most unprofitable trades or the most bearish trades in tech, those are the ones that are surging today. You've got Atlassian, Datadog, Workday, Peloton, Zoom leading the NASDAQ in the NASDAQ 100. But the fundamentals haven't changed here, right? You just talked about interest rates. They're going to continue to rise, at least for a bit. Nothing's changed here, but do you think that these valuations are starting to look attractive? They've been beaten down too much.
That's the fascinating thing when I talk to some investors and I'm like, hey, is it a good time to step in and buy tech? And what I've been hearing from a lot recently is no. They're saying just because a stock is down 60, 70% doesn't mean it's undervalued. Take a look at valuations on the NASDAQ 100 index, for example, home to a lot of big tech stocks. That's trading at around levels seen in 2019. However, the 10-year Treasury yield is still well above levels seen in 2019. So I have investors saying, look, something has to give, right? How can yields be so much higher right now, but valuations are at the same level when the risk-free rate has changed dramatically? So to some investors, that means that the sell-off will continue and that valuations have to come down further.